Folks, in today's module, we're going to talk about purchase transactions in a perpetual inventory environment. So purchasing of material is recorded in our inventory account, and again, for merchandisers, inventory is really what we have to sell in order to make a profit. So we purchase from our suppliers, we resell them at a higher cost to our customers. And the cost that we hold our inventory in should include any cost that it takes to get the merchandise in place and ready for sale. So if we have to pay to have our merchandise delivered, plus taxes that we have to pay, that should be included in the cost of inventory. If we return some of the inventory back to our suppliers, of course we should reduce that value from our overall inventory account. So our inventory account at this point is really just going to, we're going to discuss different transactions that relate to the purchasing of our inventory and how we report that in our books. So anytime we pay GST or HST, it does not form part of the cost of our inventory, because typically we'll get that refunded back once we pass that tax on to our customers. So we may pay it up front, but then we'll collect it from our customers and be refunded the HST and GST that we've collected. A couple of important notes to look at here is what we call free on board, which is where we actually transfer ownership from one party to the other. It's important to understand what type of FOB or free on board situation we're looking at. So there's two different types. FOB destination is where ownership of the goods transfers at the buyer's place of business. Okay, so if Staples is buying pens from Bic Pens, FOB destination, all the while that those pens are being shipped from the manufacturer until they reach the place of business, the Staples warehouse. That's when the title of the goods transfers or ownership of the goods transfers. On the opposite spectrum, FOB shipping point occurs as soon as the items are loaded onto the truck. So at the manufacturing point, if we load those pens on the truck, as soon as they're loaded on the truck, then ownership of the goods is now transferred to the buyer, or Staples in this case, and they're responsible for the goods while they're being delivered. Okay. Typically, we have freight paid by the buyer if we have FOB shipping point. So again, shipping point typically means that we're responsible for getting the goods delivered to our place of business, and so any costs incurred there can form part of our merchandise costs. So if it costs us $100 to get the items delivered from the manufacturer to us, and it's FOB shipping point, that means that we, the buyer, have to pay it, and we should add that cost to the cost of our inventory. All right. So there are also times that we may receive goods that just don't fit our standards, and so we may have to return some goods. And so a purchase return typically will receive either a cash refund or a credit, and we want to reduce that amount from our inventory account, of course, because we've shipped back faulty goods, and we no longer need to keep them in our inventory account. We may also choose to keep the goods, so maybe it's just a little bit of damage or the color is just a little bit off. It's not what we ordered, but we'll keep it for a discount, or what we call an allowance on the purchase price. And so again, if we receive an allowance or a deduction on the purchase price, we should accordingly reduce the cost on our books by reducing the cost in our inventory account. Last but not least, we may receive discounts. Again, anytime we hold a discount, we want to, it could be based on buying additional volume. It could be based on paying off a balance early. So in terms of a quantity or volume discount or simply an associational discount, if we receive that discount, we typically will just reduce the cost of our purchase. So again, we'll just record our purchase at the discounted price. There are other times where we may receive a discount based on paying off an account. So if we've purchased this inventory on account, so we owe the supplier money, they may give us terms with that credit. And the terms typically may provide a discount if we pay a little earlier. So for example, 2, 10, and 30. This is telling us that we get a 2% discount if paid in 10 days, and the full amount must be paid within 30 days. So if we receive terms 2, 10, net 30, basically says it's giving us an incentive to pay off our account a little earlier, to provide the cash to our suppliers earlier. So if we pay for the amount within 10 days, we get a 2% discount on the price. Otherwise, everything just should be paid within 30 days. And so when we receive this kind of discount, we're going to have to record, we're going to decrease that merchandise inventory account by the amount of the discount that we receive, and that's recorded when the payment is actually made. Because when we purchase it, we don't know whether we're going to be able to take advantage of this discount or not, and so we record it at full price, and down the road, if we do get to take advantage of the discount, we'll reduce the cost in our inventory account once we pay our accounts payable. Okay, so here's a summary of some of the transactions we look at in our purchases. So when we purchase merchandise the first time, we're going to debit our asset, known as merchandise inventory, and credit either cash or accounts payable, depending on how we settled for the inventory. If we have FOB shipping point, so again, we have to pay the cost to get the merchandise delivered to us. Again, it's an additional cost to getting that inventory, so we're going to increase that inventory account by the cost of delivery and pay out cash or accounts payable to delivery company, whatever that happens to be. Okay, if by chance we have to return some of the amounts we've purchased, we're going to either receive cash back from the supplier, or we're not going to owe them as much if we haven't paid our account yet. We may just decrease the amount that we owe them and reduce our merchandise inventory by the same amount of our discount, because we no longer have it for sale, or we got an allowance because the merchandise wasn't exactly what we had ordered. Okay, when we pay for an account payable within a discount period, so again, if we had those terms 210 net 30 and we paid within 10 days, we'd pay off our full accounts payable. We want to remove the liability from our books. We'd pay cash, but we wouldn't pay them the full amount that we owe them. We'd pay an amount less the discount that they've provided, and we'd record the discount by reducing the cost of our inventory. Okay. Now, if we happen to miss that discount period, then of course we're just going to pay off our full accounts payable and we'll pay them off cash. There's no impact to our actual merchandise inventory account. Okay, we're going to work through some of these problems and some of these journal entries in our tutorial session, so please feel free to take some time now to work through the suggested problems for purchase transactions, and we'll review them together in our weekly tutorial. Thanks so much.